Thank you so much for that great introduction. And I am going to talk about small open economies, how they are affected from the international transmission of US monetary policy. But I thought I'm going to start with the current events and current inflation, since I was expecting what the previous presentations are going to be about. I thought this is going to be a nice bridge to the morning, and then we come to the close at the end with a full circle. All right. I also have to say that this work is really going to be about, this presentation is going to be about several papers, and I'm going to list them in a second. They are going to have a common element in terms of important role of sectoral shocks and financial frictions, and that is not just going to help us to explain the last 3 years of events, but that's also going to help us to understand the US monetary policy transmission to the rest of the world. Of course, US monetary policy started tightening because of the events of the last 3 years, this highest inflation everywhere, but a big shock, especially to the US and Europe, highest inflation of the last 40 years. So the approach here is going to be micro-macro in order to identify these things and to draw policy implications. I also have to say this work is going to be joined with people at the policy institutions. The work on inflation, supply chains, trade, and quantifying the inflationary impact of policies, all joined with Julian Di Giovanni, who is at New York Fed. So our views are our views and do not represent the views of New York Federal Reserve or the Federal Reserve Board system. And it's also joined with my student Alvaro Silva and Mohamed Yildirim at Harvard. And the work on international spillovers of US monetary policy is also going to be joined with several people in New York Fed, but also with Geeta Gopinath, who is the first deputy managing director at the IMF. So again, these are our views, don't represent the views of the IMF or its board. So I have to say this since everything is here public. All right, let me start with current events and then bring it to the tightening of US monetary policy, the Fed hikes, and then how it spills over. So drivers of inflation, we all witnessed this the last 3 years. It is the highest inflation of the last 4 decades. This is true for everyone. Maybe for emerging markets, it wasn't such a big surprise because they go through these episodes frequently. But for advanced economies, it was a big deal experiencing the highest inflation since 1980s. Now, what we have also observed, large swings in economic activity across time, across sectors, across countries, because of course, of the original shock. The original shock, what I call the primitive shock, was a health shock, okay? It was COVID. So this led us to see collapse and rebound in domestic demand very quickly, collapse and rebound in GDP less quickly, collapse and rebound in international trade super quickly, which actually why Marion said during our presentation, everybody was so surprised how trade was improving so fast and we have supply chain disruption. So I'm going to explain that, why that happened and why we missed this in 2021. We being actually most economists, not us, because we wrote the first paper presented in January 2021 that predicted long-lasting supply chain disruption and inflation. All right. Now, this collapse and rebound in activity went hand in hand with consumption shift. Now, this is being called reallocation shock, but of course it's not a reallocation shock. It was an endogenous response of consumption to the original shock, which was COVID. What is reallocation of consumption? You stop going restaurants, you stop going gyms, you did your exercise at home, you bought your Peloton bike, which means, again, an increase in manufactured goods trade, because to buy your Peloton bike, that is going to be produced using the global value chains. So that shift from services, contact-intensive sectors to good sectors is going to have a lot to do with the things we witnessed. And of course, you have to account for the shift back, which has created this tight labor market problem, which is not problem number one in the UK right now, and US is getting out of this problem, which is basically, in that third bullet there, labor shortages across sectors and countries, again, related to pandemic, lockdowns, and recovery. Now, our argument is that global supply chains played a critical role here. So it is not just global supply chains are being fragmented, and let's try to understand why this is happening. There is this geopolitical push and all that. But there was all these macro shocks, right? I mean, the health shock, and then the monetary policy, fiscal policy, all these things amplified through global supply chains, and it's extremely important to understand that. And this made actually macroeconomists, I mean, maybe it was always clear for the trade economists and microeconomists, but not for macroeconomists. And they really woke up, central banks and the macroeconomists, to the importance of supply shocks, okay? This wasn't the case before the COVID. In fact, everything is demand-driven in the central bank models. This is exactly why they missed inflation. The 2021 year is the year inflation missed, and that's because of treatment of supply shocks and the production side, more like, oh, okay, this is like maybe 70s, maybe like an oil shock, energy shock, it is temporary. But of course, this was something very, very different than your standard aggregate economy-wide supply shock, right? COVID constitutes a disaggregated set of sectoral shocks, which of course central bankers, macroeconomists are not trained to work with. This is, it was a bad thing then. It's a good thing now because of this new understanding of the importance of the production resilience and supply shock. That's going to help us a lot to deal with these future problems. Future problems being climate, geopolitical, fragmentation of production, anything, we have been discussing today, in the minds of academics and policymakers really can be dealt with all these accumulation of knowledge in the last 3 years due to the importance of the interaction of supply and demand. Okay, so this is the narrative. So the sectoral dimension is very important. When we say supply and demand imbalance, and now we hear this in every single speech of central bankers, Powell talks about it all the time, Lagarde talks about it all the time. I really want you to think at a sectoral dimension, right? It's not that demand and supply is imbalanced in the country as a whole, but it is imbalance in different sectors at a different time, which is why it is extremely difficult to, conduct policies like monetary and fiscal, which is of course about the aggregate economy. So this is the narrative. COVID starts, obviously you start with a negative supply shock. And by definition, this is a health shock, right? You're either going to be sick or there's going to be a lockdown. So it's a shock directly to labor supply. Okay, I think this is, we all agree, no matter how it comes from you get into this world of supply chain disruption immediately. At the same time, there was a demand shock, relative, right? Demand shock was always relative. So you shift from services sectors to goods sector. It wasn't a demand shock like 2008 when everything collapses because it's led with a financial crisis. This wasn't like that. There was nothing going on in the financial sector, but suddenly no one can go to restaurants and gyms and all that, right? So that increases your goods consumption, which is going to be a big explainer why trade recovered so quickly, but it decreases your services consumption, related to all these things. So you're in this world of supply chain disruptions. So this is 2020, 2021. Then what happened? We started seeing this huge unemployment. Governments cannot stand alone. When they see that, they pushed stimulus, but they did like a tremendous amount. I mean, this is for all the countries. US is, of course, here, always pointed because it's just like a ridiculous amount, over 2 trillion. But still, every government did something. Even emerging markets, small open economies, if you compare to their historical standard, they did a lot. So we wrote the Jackson Hole paper on this in 2021 with Pierre-Olivier Goinsha, Veronica Penchovok, and Nick Sender. We have this whole graph that shows you how much every country did, including Sweden, including European countries. But yes, I mean, US thing is like, out there. Now, what does this mean, this aggregate demand stimulus? You are going to put this thing on steroid, right? Okay, you stimulate the economies, that means, and then without recovering from COVID completely, you are going to increase good demand more and services still not recovered. That means worsening supply chain disruption, of course, inflation. I mean, inflation bound to happen out of this scenario. In fact, our early paper presented January 2021 at WHO press conference. I was the only economist, and we were arguing, if we really want to get out of this, we have to do global vaccination. The paper titled Economic Case for Global Vaccination, because that's the only way to get rid of the sectoral shock, and through all the sectoral linkages, everybody's going to be affected from it. And then we presented this in March 2021, both at OECD and IMF panels, and people are saying, we are just predicting a doomsday scenario. The only people that were saying the same thing at that point with us is the CEOs of the shipping companies. I mean, literally. So, so in fact, Financial Times covered our paper together with the CEO of the Merck, saying this is going to go into 2022, and of course, result is going to be inflation, which is basically what we were saying. And in the second paper we did for ECB Sintra conference for 2022, we work out the inflationary implications, and that paper covered in the press as Larry Summers was right for the wrong reasons, because the original start of the inflation is not the demand stimulus, but the supply chain problem. So the prices increased first, that led into the wages because of this aggregate demand stimulus. All right. Okay, let me start showing you the stylized fact, and I quantify this, and then I go link this to the US monetary policy, and then spillovers of the US monetary policy. Very important, very important stylized fact here is the simultaneous slack and inflation. We criticize central banks across. Every single central bank has been criticized so far, with the exception of literally Brazil, Peru, and Colombia. Why? Because Brazil, Peru, and Colombia started their tightening campaign early on. They were ahead of the game, great. But, you know, apart from those central banks, every single central bank criticized, most heavily, of course, US and Europe, saying they missed inflation. Which inflation they missed? 2021. There is this vertical line here so that 2022 here. So anything you have in your mind when I say supply shock, oh, Russia, Ukraine, energy, that is after this vertical line, okay? Russia happened in 2022. The year inflation missed is 2021. Okay? Now, let's look at 21. Of course, you know, hindsight is 2020, but put yourself in the policymaker's shoes in 2021. In 2021, yes, you had the headline inflation increasing in Europe, in United States, and in Europe, but look at employment to population ratio. You were not back to the pre-pandemic levels. You know, it's a very tough call for central banks to start increasing rates when you have slack in the economy. And this actually played out in different sectors at different times. So it was actually a very hard call. Yes, you know, we were quick to say, oh, they thought this is transitory and all that. Okay, but at the same time, inflation started picking up when there was slack in the economy, which, you know, you cannot compare to anything else. The other side of this is going to be now uber employment, like super tight labor markets, and inflation is coming down slowly. Okay, so this is how we start. Now, of course, the key explanations for this is the supply chain disruption. So this is the global supply chain pressure index of New York Fed. You see they completely coincide. This original blip is because of the early Chinese lockdown. This is global index, so all the major countries are here. But the point again, 2021, the year inflation missed, global supply chain pressure and inflation completely went together. I mean, you know, we do it for every country. I'm just showing you US and Europe here as the most criticized central banks. You see that it was very important that the product prices increased first. That went ahead, of course, with trade recovering and inflation before and then we got hit by the energy shock and all that in 2020. Now that says, okay, we have to look at a sector. Look, when you look at the sectors, durable good consumption went, of course, haywire in the United States. Non-durable goods and services, they increased, you know, somehow, but services literally start recovering at the end of 21 and then 22. Europe, I mean, services didn't recover well into half of 2022, okay? And then they didn't experience the same increase in durable goods. But of course, when we look at the inflation side of the picture, the, you know, focus was on headline and core originally, you know, increasing both in euro area and United States, and core inflation too, and then start coming down, of course, in 2022, US early on, because US started tightening the monetary policy early on. But the real story is not this. Real story is this. This is exactly now, if you listen press conference after press conference, you know, in the US and ECB, they keep talking about headline core minus housing, this labor market. Right? So they keep talking about sectors and layers, right? Because they, of course, at the beginning, you know, they missed the story, but they caught up. They caught up pretty quickly. Now you see here, you know, at the end of 2021, again, you know, this is 2020. There's nothing going on with services, like less than 4%. Look at the goods inflation. Good inflation was like 12% in the US. In the euro area, it's 6%. I mean, now, of course, you know, by 2023, services inflation is up in both countries. Goods inflation coming down. Just this itself is going to give you, you know, over 2-year inflation, which wouldn't be transitory by any standard business cycle metric, but also wouldn't be permanent, right? Just these different sectors going through inflationary pressures, different time. Okay, how are we going to model this? I promise I'm not going to show you equations. This is going to be an extremely complicated model. I'm going to show you one equation for inflation, but let me try to give you the intuition of the model with a figure. We are going to do a full-fledged macro general equilibrium global production and trade network model. This is going to be the model. I'm going to show it in your pictures, and I'm going to tell you why it's important to understand this is not just a trade network, it's a production network, okay? We are too quick to say, oh, supply chains and then trade and all that, and then we go and think about this, okay? When we look at this data, we always think about this, and that makes you think immediately about trade, right? Tradable goods, tradable sectors. So then you say, well, if tradable goods and tradable sectors are doing all fine, we're seeing all trade, why we have supply chain disruptions? you can have that because supply chain disruptions are also about domestic links, right? This is trade. I mean, countries that are very open to trade in dark blue, like Ireland, countries that are less open, US in light blue. You see the intensity of the network with the thickness of the lines. Europe obviously is going to be a big part. But I want you to envision this figure, the domestic input-output linkages embedded in this figure, right? Again, if you only think from the trade side, you would say, well, computers and electronics, the tradable sectors are in red, non-tradable sectors are going to be pink, wholesale, retail, and construction. You would be thinking more about this and not less about that. But of course, the big deal why the prices in the construction sector went up is because they couldn't get the steel and lumber and the wood, right? So we have to think to fully appreciate the supply chain disruption, how trade can go up and supply chain disruptions can stay a long time, and how macro policy can incentivize these things, is we have to embed this to this. And this is going to be our model, right? We are going to have, think your standard trade network model, but we will do it at the macro model with some nominal rigidities, such as downward wage rigidity, so we can talk about monetary policy and fiscal policy and how these things interact. I will show you in a picture how factor markets get into this. Of course, this means you have to think about the factor markets. These guys are going to be trading intermediate inputs within each other, and of course, when you put this figure here, some of those intermediate inputs are going to be imported, some are going to be between the sectors, okay? So you have to be modeling factor markets in detail with all the sectors, and also you have to allow it that this is an open economy, small open economy, where a lot of these inputs are going to be imported. If you're thinking about these factor markets, and the only assumption we are going to do is the factor markets are segmented. What does it mean? So you cannot substitute. Okay, we were talking about this early on. Of course, this is a nonlinear model where all the prices, including exchange rate, is going to be endogenous. So everything is going to adjust, and because of that price adjustment, you are going to start substituting. That is going to happen, but at some point. That's very important, right? Because in the models, when they don't have any dynamic dimension, in the steady-state model, this thing happens like, whatever, 10 years down the road. That's not going to help me from a policy perspective. I want to know what happens within a year, in 4 quarters, within 2021. It is going to be super, super difficult to do the substitution, even prices are adjusting within a year. This is what the price rigidity is going to bring you. First, prices are rigid, they are going to adjust slowly, so substitution is going to slowly. So you have to work, within the 6 months, a year period, with price adjusting slowly, and substitution is somehow not working. And in fact, it's the opposite, it's complementarity. So how do you bring this into a model? You assume segmented factor markets. What is a segmented factor market? When restaurant workers were fired and those gyms got closed, those people couldn't go and drive the Amazon trucks when everybody's ordering online groceries. Or those people cannot start working in the construction sector and come and do your home office or produce another laptop for you so you can buy for your children's education from home. Okay, that is the segmented markets for labor. You can think the same thing with capital, because some of this capital is going to come from other countries. China puts a lockdown, you cannot import the steel, your construction project is going to be delayed. I mean, everything is going to adjust at the steady state at the end, but these transitional dynamics, these delays are going to be very important. Now, you start from this equilibrium point, okay? So this is let me talk about labor, because labor markets are going to be very important in this story, especially in 2022 and 2023. This is the potential labor supply, labor demand, wage. Of course, originally, because of the pandemic shock, the labor supply is going to shift in. There is a downward wage rigidity. That's the only rigidity, right? So wages cannot go down, but they can go up. A lot of the inflation we are seeing right now is actually wage inflation. So that is allowed, but they cannot go down. They cannot go down means you can easily match this unemployment issue in the real data. So of course, original demand goes down, right? This is the first part when demand went down, and that's because when labor demand and consumer demand went down, because wages cannot go down, you are going to have this unemployment. The original papers show this effect and call this Keynesian unemployment. Is the work by Bakai Fahri, Veronica Guriori, Ivan Werning, Ludwig Strauss, and all that. So these guys did it in closed economy and called this Keynesian unemployment effect. Our difference from them, we are bringing it to the open economy doing the entire global network. Now, what happens during, so this is the original phase where we have the unemployment problem. What happens during recovery, of course, now the demand improves. Where are you? I mean, you can be anywhere, right? You wouldn't know this from the model, but the model is going to help you to run this counterfactually. You know where you are. You can be here, you can be here. If the labor supply improves, you can be here. But basically, you are going to be at an inflationary point with uber employment, right? This is this tight labor market problem that US was dealing with, UK is now dealing with. There's this wage inflation. All the policymakers are afraid of, wage price spirals and so forth, right? This labor market seems to be not giving up. Okay, so that's, you are at a point like that. But you see how the whole thing progressed. Original supply shock, demand went down, demand went up, and that is, of course, all about the government policies. Okay, we are going to quantify this. So this is the model, and we are going to quantify this. Only equation I'm going to show you is this. So the nice thing in these macro global network models is you can write the inflation. They are nonlinear models, but you can do a first order approximation to inflation. So this is inflation, right? The D log CPI, CPI inflation in any country. And remember, you can do it for every country. In fact, our quantification is 65 countries, 46 sectors. Okay, so this is going to be like 3,000 by 3,000 matrices. So you can do this any country. So inflation in a country is obviously their own country's own aggregate demand shock. And this aggregate demand shock is going to have everything in it: fiscal stimulus, monetary stimulus. You can say, well, in 2021, monetary policy was loose. Exchange rate adjustment. All the prices are going to adjust. Exchange rate is going to shift the demand. All those things are going to be there as in your traditional models. Okay, nothing is different there. What is different, and it's a very important insight to understand this phenomena, is these labor shocks. Productivity is also there. You can see productivity improvement anywhere is going to be disinflationary, as in a standard Phillips curve type of model. What is going to be inflationary is the labor shortage. Okay, so the labor goes down, minus, inflation. Any labor shortage in this model, this is equilibrium labor, in any country is going to be inflationary in your country. Okay, that's the big insight, because this is in any country. These things here are the network weights. So it depends how big your sector is and how connected your sector is. Okay, so factor shares and donor weights. There are details I can explain later. But the important thing is your aggregate demand shock is inflationary, positive aggregate demand shock. Productivity improvements are disinflationary in any country. Those are the standard things. The new thing is now you can get inflation from labor shortages, and if it's happening in one country because labor is complementary with all the other inputs, and because you are importing other inputs, this is going to affect everyone. So when China lockdowns, it's going to affect us, okay? So it takes this global integration as is. We might be changing this now moving forward, but we use the data as of 2020, we enter this world, and all the COVID shock and the macro shocks happen in this world. Okay, quantification. So what we did originally is on purpose. This is the paper we did for Sintra, inflation drives before the Russia war. For euro area, 45 sectors. First of all, the nice thing with these models, they are going to match the observed inflation. When we did this paper, there wasn't a single central bank model that can match inflation. Nobody can predict that 9% inflation. You can easily get this from these models. 9% in the US, 5.7 in the Europe. The real inflation at this point is like 8.7 in US, and in Europe, I believe 4.9. So you come very close. It's not exact number because, of course, it's a nonlinear model. This is the inflation, and this much comes from aggregate demand. This much comes from sectoral supply in Europe. So in Europe, and this much from the sectoral shift. In Europe, it is basically half-half. Okay. In US, more from aggregate demand, and this much from supply. So the rest is demand. But this is important. I mean, a lot of people interpret this work as saying, oh, you see, it is all fiscal stimulus in the US. Well, okay, it is more, but this is saying without the 3 percentage point coming from the sectoral supply shock, which also comes from other countries, you would have been trying to reduce 6% inflation when you started tightening the monetary policy in 2022 instead of 9% inflation. Okay, so that's the point. Monetary policy, of course, can be very effective in this environment because monetary policy is going to crash this, But the point of this work is you are going to keep having price pressure and high inflation as long as you have this supply shock. This is why it's very important when think about the future. If we are going to a world where it is fragmented, climate change, geopolitical risk, where if this is a world with more sectoral supply shocks, look, I'm not even saying energy shocks, sectoral supply shocks, that world is going to be inflationary. And if you do demand stimulus in that world, it is going to be even more inflationary. Okay? So this is the key conclusion here. And then we did the over time to show that, the supply shock's more important. Originally, demand shocks later. Now we add energy. Energy is going to be a huge deal, of course, for Europe after the Russia-Ukraine war. This is the nice thing about this work. You can, identify which shock is contributing how much in any country. Okay. Fed started tightening the monetary policy at this juncture, pretty much in 2022, and in 15 months they have to tighten a huge amount. So how do we think about that process, and how can we use our previous knowledge accumulated in international finance macro to understand this episode of Fed hikes, which was extremely fast, We are talking about a 5 percentage point tightening in a period of 15 months. What do we know about international transmission of Fed hikes? So this figure meant to be confusing. So if you look at this and confuse, that's its point. Why it meant to be confusing? Because it is trying to tell you how fragmented the literature is. We were talking about this during Marion's presentation. The literature on the international transmission of Fed hikes or international transmission of US monetary policy in general, basically one arrow. So there are so many papers, but every paper looks at one arrow. So it is very difficult to understand the overall effect. So let me explain. First of all, there's going to be a trade channel, which is 90% of the literature, because this is the ISLM open economy, Mandel-Fleming, whatever you want to call it, but that's what we teach to our undergraduate students, right? How does that work? So when Fed hikes, let me tell you the hiking case, but of course easing case is going to be symmetric. But when Fed hikes the interest rate, which is what is happening right now, there's going to be a strong dollar. It is endogenous, right? What Bo was saying, exchanges are endogenous, so Fed is not trying to do this to strengthen the dollar or anything. So exchanges are endogenous objects to all these things. The model I was just telling you about, exchanges adjust endogenously. But of course, an artifact of increasing the interest rates, you increase the return to that currency, which is dollar. So the dollar is going to be strengthening relative to other currencies. And that's what we saw in the data. Now, strong dollar means several things. In the standard ISLM Mandel-Fleming model for Mexico or Sweden, okay, for the other country, that's going to be lower imports because, now it's expensive, but higher exports. Because dollar is strengthening, krona is depreciating, peso is depreciating, that's good. That's the channel we call expenditure switching, okay? So that expenditure switching channel should, basically smooth out the effect of a strong dollar in your country. Now, the problem with that, we don't find it, especially for emerging markets. For advanced economies like Sweden, Canada, UK, Switzerland, maybe sometimes, but it has never been a robust finding in the literature. And of course, once you go to emerging markets, you actually never find that strong expenditure switching effect. You kind of, grow because now your exports are very cheap. In fact, in emerging markets, you find a contractionary effect. People try to explain this with a couple things. First, of course, strong dollar means high pass-through in emerging markets. The advanced economies like Sweden, Canada, UK don't have this problem, but emerging markets do have that problem. It passes through your inflation. And if you have an independent central bank, if you're a floating currency, if you are not pegging to dollar, you have to react to that inflation problem. You have to increase your own interest rate. This is known as mimicking the Fed. Even you are a floating exchange rate regime country, if you have an inflation problem because of the strong dollar passing through import prices, you tighten your rate, and of course you reduce your GDP. That explains contraction or depreciation. Or, originally in Krugman's paper, then, in several papers, you borrow in dollars. We talk about that. Dollar is, currency that dominates trade and dominates finance. The world finance is in dollars. The world trade is in dollars. If you borrow in dollars, that means strong dollar is going to, mess up your balance sheet, call your governments, or your banks, your corporates, and that means lower investment, because with a weak balance sheet, you won't be able to borrow and invest. That lower investment is also going to give you a contraction or depreciation. So this is how, literature, traditional literature sees the trade channel. What about financial channel? There's also a financial channel which gained prominence after the influential work of Helen Ray on global financial cycle. And the financial channel says, look, it is not just that trade channel is helping you. Trade channel should help you, right? When dollar is strong, when US interest rates high, you should be able to export your way out of it. It's not that it's not working. you are actually getting really hit by this adverse financial channel. Financial channel is a very adverse channel because it's going to work on two things. First, cost of capital. If US is, the world interest rate, now it's a higher safe rate, higher cost of capital globally. Second, risk premium, right? This premium is going to be heterogeneous across countries. As Sweden, you might have low risk premium, you have a lower risk premium, but of course, as Turkey or Argentina or Mexico, you are going to have a high risk premium because emerging markets are the risky asset class, okay? So that is going to mean for emerging markets, lower debt, lower investment, lower output. That's going to work through either some sort of balance sheet friction or some sort of asset riskiness. And if this is combined with the foreign currency debt, and if the emerging market here responds to defend that currency, then you are going to make things worse. It's not that the global investors already charging a risk premium to you, and you are going to react by defending the currency because your currency is depreciating, you are going to make the contraction in your economy worse, okay? If the financial channel is strong in your country, you are going to have even a worse contraction than what is going on through the trade channel. All right. How can we now quantify these things? Heterogeneity is going to be the name of the game here. It's going to be super important what type of the country you are. And here, I really want to emphasize, we are talking about small open economies, but small open economy and emerging market is not the same thing. I think for a long time in the literature, we treated them the same, but they are not. And now we understand they are very different because things don't work the same way in Mexico and Canada. And they are very good examples because they are trading partners of the US. They also don't work same in Sweden and Mexico or Turkey and UK and all that. So there are they're all small open economies. They're all small open economies, but the reason why they don't work the same because the financial channel really works badly on emerging markets as financial investors charge a high risk premium. Composition of capital flows, risk sentiments of investors are going to be exactly about that. Financial channel is going to create a lot of heterogeneity across countries. Dollar debt, obviously not every country is going to be having a dollar debt problem, and other fundamentals is going to be different. And very importantly, credibility of monetary policy and institution environment. I'm actually going to argue that monetary policy of countries and strength of their balance sheet in terms of lower dollar debt are the only tools the countries can have in terms of dealing with the bad effects of US monetary policy. Because that is what is going to affect the risk sentiments of the global investors towards these countries. That's going to affect capital flows. That's going to affect risk pricing and so forth. So instead of trying to engineer like a currency depreciation or trying to make their exports cheap and get by like that, they actually should focus on the credibility of their own central banks, their own monetary policy, and they should watch out how much dollar debt accumulation in their economy. They would be way better off if they do that instead of trying to manage the exchange rate. Okay, here's the story in 4 graphs, and I'm going to show you Turkey here. Turkey would be a very good example because it's a country now with okay, they are trying to fix things, but it is very, at least till the last moment, till a couple months ago, they had zero policy credibility. Central bank lost independence and all that. So now things seems to be changing. There is a new team, new finance minister, new central bank governor. So they seem at least abandon this crazy idea of lower interest rate is going to lower inflation. So now at least they believe higher interest rates are going to lower inflation. But I'm going to show you figures for Turkey ending in 2013. Why? Because this period, 2003 to 2013, it was a textbook emerging market. Inflation was right on target. They had a 5% inflation target. Inflation wasn't higher than 6-7. It was a big success story of IMF program. There was a big crisis here. At the same time with Argentina, triple crisis, balance of payment, bank, and sovereign. IMF come in, and IMF program was intact until 2010. Super successful program, single-digit inflation, EU accession, capital flows in. Literally, we were using this period to explain international economics one-on-one to students. So everything worked great. And this exactly tells you how important monetary policy credibility is, because obviously everything went downhill after 2015 when these policies start being changed. But this is very illuminating. What is this? This is, every figure is going to be plotting VIX. We heard in Nick's presentation, it is a measure of global uncertainty, also used as a measure of global financial cycle. In Helen Ray's work, this is the most important common factor that describes global financial cycle. I call global financial cycle GFC here. Global financial cycle is this global movement of capital flows, risk asset prices, leverage, and all that, okay? So I'm going to be plotting VIX in every figure on the right y-axis in black, again, the period in 2003 and 2013, and I'm going to plotting 4 variables that is going to be very important in understanding this transmission in blue. This is going to be the lending rate, short-term lending rate of firms to households. So this is a Turkish household, a Turkish firm borrowing from a Turkish bank. You see that if you plot the policy rate here, it is going to be correlated with that, of course, but it is more correlated with the global financial cycle. So for emerging markets, small open economies that run current account deficits and borrow from abroad, their lending conditions, domestic credit conditions, are going to be tightly linked to global financial cycle. This is the other side of this, the quantity side. The non-core liability is all the liability of the banks that comes outside. Core liability is the household deposit. Non-core liability is what banks borrow from outside. Of course, negative correlation, right? When global financial cycle turns, then banks can borrow less. When it is easy, banks borrow more. This figure is going to be super, super important, and this is going to be linking directly to policy credibility and also policy uncertainty index Nick showed us in his presentation. What is this? Again, global financial cycle in black. The blue is UIP. UIP is uncovered interest parity, a very important parity condition that we worked with in all our models to understand international financial integration, international arbitrage. UIP has to hold for international no arbitrage condition. If it doesn't hold, a lot of things start going wrong, and in the data, it never holds. 99% of our models assume it holds. Not only that it never holds, so if it holds, it is going to be at 1. Not only that it never holds, it fluctuates with the global financial conditions, right? So it's a positive correlation, meaning when global financial conditions easy, when capital flows come into the country, here Turkey, UIP goes down. When global financial conditions tight, which is going to be correlated with Fed hikes, capital flows out of the emerging market, UIP increase. Again, UIP condition is your interest rate minus US interest rate minus the expected change in the exchange rate. So once you adjust for your expectations, the exchange rate, the return to currencies should be the same. Another way of putting UIP conditions, excess currency returns. So you can see that emerging markets is always going to be positive. Emerging markets always pays excess currency returns to investors. So it always pays off to invest in emerging markets, actually, with all the mess up they do. So this is going to be common for other emerging markets too. All right, now 43% of the cyclical credit growth is going to be due to global financial cycle in emerging markets. The key channel is going to be falling risk premium, which means lower borrowing costs for the average firm when stuff coming in. Is exactly the opposite when stuff going out. The important thing is the pro-cyclicality in the UIP risk premium with the VIX tells you that local currency borrowing becomes cheaper and increases during the boom phase of the FIC. What does it tell for the policy? You just cannot do it by just eliminating dollar borrowing. You have to have both. If you just say, okay, I'm just going to ban the dollar borrowing, I will be done with it, well, they're going to borrow in local currency. Local currency borrowing is going to be cheaper when capital flows coming into your country. And the banks are going to arbitrage the profits, right? Banks are going to have these UIP arbitrage profits. You will still have the credit boom problem. So it's going to be very important to understand that this story goes through lower risk premium and lower borrowing costs. Limiting the foreign currency borrowing is important, but not enough, right? It's necessary, but not a sufficient condition. What else you can do? So hopefully in my last 5 minutes. Now, let me go through this endogenous policy response. They are obviously going to be exposed to global financial conditions. This means when US tightens, you can increase the policy rate. This means to defend the currency when the global financial conditions tight, or you can lower the policy rate to stimulate the domestic activity. So it is a challenge to undertake domestic monetary policy in emerging markets. So what else can you, and what do you do with the monetary policy? So basically, in this work, we show that monetary policy is going to be counter-cyclical. Central bank actually going to be lowering the policy rate during recessions, unconditionally, conditional on US monetary policy, and during the periods of stress. So this means there is going to be a short-term disconnect. What do I mean by that? Even you lower the policy rate, because risk premium is the central story here, your short-term market rates are going to be going up during the tight global financial conditions. And this short-term disconnect, the difference between the market rate and the policy rate, are going to be moving all these things like dollar premium, UIP, CIP, VIX, and all that. Let me show you that. First, 3 episodes: global financial crisis, taper tantrum, COVID. Advanced economies, everybody lowers rates. Here, Iceland is going to be an outlier during the global financial crisis, but basically everybody lowers rate. Taper tantrum is this shock during the Ben Bernanke's speech in 2013 that led to capital outflows out of emerging markets. You see that emerging economies are behaving very much like advanced economies. Only Russia and Hungary raised rates during global financial crisis. Everybody lowered. Taper tantrum, Brazil and Indonesia famous to raise rate because they defend the currency. They went out on the record and say they are doing this to defend the currency, but mean and average is going to be lowering the rates. We run Taylor rules, the same thing, right? Taylor rule estimation is going to be very similar for emerging markets and advanced economies. They are lowering the rates. It's counter-cyclical. So during good times, there's growth. You raise the rates. You are not different than advanced economies. And as a response to U.S. monetary policy shock, now U.S. tightens. You lower the rates. But in spite of lowering the rates, you are going to, and the Fed is tightening, you are not mimicking the Fed, you are doing opposite to Fed, but you have all sorts of bad outcomes. Capital flowing out, inflation increase, GDP goes down. Okay, you still, see these contraction outcomes in spite of you lowered rates because your monetary policy is not fully effective. And this is how we show it here. Look at the advanced countries first. The blue is the policy rate. The reds are the two short-term market rates, treasury rate and money market rates. There is no difference between them, so there is no short rate disconnect. In emerging market, even the policy rate increases during good times. The other ones are decreasing because capital flows coming into the country, your exchange rate appreciate, so there is a disconnect between the policy rate and the market rate. Okay? Final slide. So what does it mean? The opposing movement in the policy rate and the short-term market rates, emerging markets affected worse from Fed hikes, and their monetary policy is not enough to counteract the Fed hikes. Does this mean they are helpless? No, they are not helpless. This brings me to the role of policy credibility and the balance sheets. So here again, I'm showing you the worst effect, higher inflation than lower inflation because economy contracts in emerging markets. Everything red is emerging markets. I show you the same effect now using both emerging markets and advanced economies. This happens in low credibility country. When your monetary policy credibility is low, you are going to have much worse effect in terms of inflation, and if you have high FX debt, you are going to have much worse effects. Okay? High FX debt countries are going to be low credibility countries. If you have high FX debt, you also have low credibility of your monetary policy. And in terms of how you link to the risk pricing, UIP premium is the risk pricing of global investors. I plot UIP premium here in black. This is the emerging markets in black, and this is the advanced countries in black. And blue is NIC's economic policy uncertainty index. This is for advanced economies. You see there is no correlation between your policy uncertainty, we interpret it as policy credibility, and UIP if you are Sweden or Canada, but there is a huge correlation if you are Turkey or Mexico. That policy uncertainty, exact same thing Nick showed you, feeds in directly to monetary policy credibility. Why? Because you say something and you do something else. You say your inflation targeting means you can use policy rate only to target prices, then you go and defend the currency. This is saying something and doing something else. This creates a lot of policy uncertainty. This erodes the credibility, and that is going to be priced in as a risk premium and by financial investors. That means you have to keep providing excess currency return to global investors as an emerging markets because of your own problem of not doing your job right. Okay, not because these horrible investors asking for money. No, you are not doing the monetary policy right. Your monetary policy is not credible. Okay, and this is not same as EMB, the default risk. It is more than that because default is rare. You can see that EPU, we already saw in Nick's presentation, is something fluctuates in the short term. All right. Final slide conclusion. What I told you today, global production and trade network played a very critical role in recent global inflation. Under sectoral demand, sectoral supply, and aggregate demand shocks, when inputs are complements, you have to put together all these shocks to understand this. Risk premium is important for the heterogeneity in the international transmission of US monetary policy. I mean, these events are going to happen, and there is going to be inflation, and US is going to react to its own inflation. Nobody can blame Federal Reserve for that, or ECB. But if you're an emerging market, you have the control on this risk premium, because risk premium is going to be really make things worse for you. Emerging market monetary policy stands, in fact, counter-cyclical. They are trying to do the right thing with the monetary policy, but if if they are not credible in that action, then they are not going to smooth out the effects. And that's what happens with the global financial cycle, leading this limited monetary policy effectiveness in emerging markets, not in other small open economies that are advanced. And the way to get out of this vicious cycle is credible monetary policy and low dollar debt in your economy. So you don't need to make your policies uncredible by defending the currency with monetary policy, right? You shouldn't be doing that. And that's going to help you to smooth the effects of Fed hikes. Thank you.